Mark, are there signs to you, and I'm looking at housing in particular, as well as potentially other sectors, are there signs to you where you could start to see that inflation start to tick up?
No. Gold, Lisa? Gold, really? That's what you're pointing to? Come on. No. Inflation is back in the bottle. I mean, the thing that I think the most important to look at, inflation expectations. And there's lots of different ways of looking at that. You can look at the bond market and what the implied expectations are. Go look at the surveys that are being done by the New York Fed, the Conference Board. Inflation expectations are all the way back in. So, as long as that remains the case, and I don't see a reason why that's going to change, I'm not worried about inflation, and housing, absolutely not. I don't think that's going to be the issue here going forward. I mean, if anything, in the next 12, 18 months, we should see further deceleration in the growth of the cost of housing services, because there's this such a long lag between what's going on in the rental markets and when that actually shows up in the inflation measures. So the next 6, 12, 18 months, I think we're going to see, further deceleration. In terms of setting monetary policy and interest rates, I think you shouldn't even be focused on particularly owner's equivalent rent. That's the posted cost of home ownership. Lots of good research coming out of the Fed saying that's, probably something you shouldn't be focused on when trying to set policy. And I totally agree with that. So set that aside. You know what inflation is? CPI, core inflation, PCE, consumer expenditure related inflation. It's well below 2. It's kind of like 1.5 to 1.6, 1.7%. And it's been that way for more than a year. So that feels like, to me, the more salient, measure of inflation. And that says not only are we, at target, we could be beyond target. So no, I'm not worried about inflation.